currencies are backed by a nation's taxing power, whereas the appeal of cryptocurrency is that there's no government involved. So, Caitlin, I'm going to put you in the hot seat first. Where does Bitcoin derive its value from?
Bitcoin derives its value from scarcity and from network effects. Its value is entirely subjective, which I understand is a difficult concept for folks to get their arms around. The value of fiat currency isn't, I would challenge, it isn't in the fact that it's the nation's taxing power. The value of fiat currency is the productive capacity of all the assets and people in that country. Whereas for Bitcoin, the value really is the productive capacity of all the people and the assets in the world. And to the extent that it does become a monetary instrument, it represents a call on all the future production and capacity of all the people in the world in the future.
So Joey, come in here next. Would you agree with that, or what would you add?
Yeah, I definitely agree with that. I mean, I think what I'd add is I view Bitcoin as it's sort of like the most pure asset that exists. Critics like to say it doesn't really do anything, and that's sort of the point. Some people call it digital gold. I agree with that thesis, and I think the most powerful thing about Bitcoin is that the supply can't be debased. There's only ever going to be 21 million Bitcoins, and I mean that's a lower inflation rate. Bitcoin already has a lower inflation rate than gold does.
And Nick, bring us home. I mean, what is that? Do you also view Bitcoin as a digital gold of sorts? Is that where most of the value is today?
Yeah, I think gold is a convenient and reasonable analogy for Bitcoin. You can think of it as a dematerialized gold, that process of rendering it digital, but still retaining some key monetary properties like the hardness of issuance, the supply schedule, the relative fairness of issuance. It inherits those properties from gold or has similar, those are innately comparable, but then Bitcoin introduces new properties because it is dematerialized, so it's highly transmissible, it's programmable. It's very easy to verify and prove ownership of some value. That's really critical. It's easy to take physical delivery of the asset. So it contrasts really favorably with gold along those dimensions. And as Caitlin says, it's an intersubjective consensus, the value of Bitcoin. But because it improves upon gold in those key respects, I would say it has the potential to surpass it as a monetary medium, but it will ultimately be a spontaneous, wholly free market phenomenon.
So Nick, I want to stay on you and the idea of Bitcoin as digital gold, because it feels like the conversation around Bitcoin over the past year really has shifted from it being a form of payment to a store of value. Compared to 2017, there's far fewer articles on whether I can buy a cup of coffee with Bitcoin and more about it being a cash alternative or an alternative to gold. So I'm curious whether whether those two use cases can live in harmony, or at a certain point, will the community have to prioritize one over the other?
Well, we've had these debates really since the founding of Bitcoin. In fact, the first response to Satoshi on the mailing list in 2008, when Satoshi proposed Bitcoin, involved Bitcoin's ability to potentially scale up at the base layer and satisfy the world's payment capacity. So this has been a problem that we have debated, literally since day one. And in fact, the Bitcoin community kind of fought a civil war over this. Do we want to increase the throughput of the base network itself, or do we want to build in a layered fashion? And I would argue that the side that was advocating for that layered approach prevailed in that conflict of visions, and that is really the main way we see people building on Bitcoin today. Understanding that there are constraints in terms of the data overhead of the network, and that it's more likely that Bitcoin will evolve to mirror the way that payments and settlement networks work in the established payment space, where you have utility scale settlement networks at the base, similar to Fedwire, for instance, and then many layers on top of that where payments occur, where settlement is not immediate, settlement is deferred. And that is the vision that I see most Bitcoin developers and corporates working towards today, that layered approach, and that's the one that makes the most sense to me, frankly.
So, Caitlin, I'd love to bring you in here since I know this is something you've spent a lot of time thinking about. I mean, where do you fall on that sort of debate, a payment versus a store of value?
Well, right now, I think the character of Bitcoin has changed as its price has gone up and as its network effects have literally exploded, especially in the last 5 years, but throughout its whole history. And Nick is absolutely right. Money is layered. Money in if you think about central banks is layered. The only central bank money that most of us have access to is our physical paper bills. Otherwise, the money that we consider to be dollars or euros or yen is mostly bank deposits. That's a layer two on top of the base layer of commercial bank of central bank money. The monetary base is, to put it in the M's for those economists out there, monetary base is M0, and then you've got M1, which includes banknotes, and then M2 and M3, et cetera. And so we have layered money in traditional money. And where Nick is going, and I completely agree with him, is that Bitcoin itself has evolved to be the base layer of a Bitcoin ecosystem. We have so-called layer two technologies like the Liquid network, like the Lightning network, that are built on top of that base layer where Bitcoin itself is the base money, and then we actually have other technologies that are anchored to it. The big difference with Bitcoin is that those layer two technologies are not leverage. M2 through traditional fractional reserve banking represents leverage. But in the Bitcoin system, those base layer and those upper layer two technologies are anchored to the base layer. So you're not actually destabilizing the system by introducing leverage by introducing these layer two technologies. One last quick point. Someone pointed out to me that Bitcoin itself, we call it the base layer, but if you look at it from the internet perspective, this person looked at it as layer 7. It's the monetary layer of the internet. And so these layer 2 technologies that are being built in the Bitcoin network are really layer 8 of the internet, to use his analogy.
So I want to go back to the digital gold theme, because as a cross-asset reporter, I spend a lot of time talking to investors and discussing the value of Bitcoin, and inevitably it gets compared to gold a lot. So Joey, a common pushback I hear to Bitcoin being pitched as digital gold or as a cash alternative is that it's so much more volatile than either of those things. For example, if you look at Bitcoin's 30-day implied volatility, it's about 6 times higher than that of gold. So I'm curious, what would you say to an asset manager or to a corporate treasurer trying to reconcile that volatility with their balance sheet?
Yeah, so I think, one way to reconcile the volatility is to just size the position appropriately, right? So you would put on a smaller position size to start off with. I think the other thing is the volatility here is a benefit of it. If you think about Bitcoin, you're effectively buying a call option on, either the future of what people use as a store of value. I don't really know anybody in my age bracket who owns gold, but, maybe 30 to 40% of the people I know own Bitcoin. So that's one angle. It's a call option, and volatility is good for options. I think it's all about, if you're a treasurer trying to decide whether to put a Bitcoin position on or not, part of it's just in the sizing of the position. Obviously you don't want to take too much risk so that you can't sleep at night, but I think the volatility is a benefit as opposed to a downside here.
Well, a follow-up to that is, I mean, in terms of sizing the position appropriately, what do you think is a reasonable allocation if you're a corporate treasurer, for example?
Yes, I think part of it depends on your risk tolerance, right? I think Mass Mutual recently put 100 million in, and in their balance sheet that's negligible. That would be like $5 in my wallet. Versus if you look at a company like Square, they put 5% of their cash into Bitcoin. It's just a personal view. My perspective is I think the appropriate numbers somewhere between 1% to 3%. Something where if it goes up 10x, it's super meaningful, and if it goes to 0, which I think is incredibly unlikely at this point. But if it did, you only lose 1% to 3%. It's not a going concern risk for your business.
Right. And so, Caitlin, I want to swing this question to you because Tesla and MicroStrategy have obviously made big waves by adding Bitcoin to their balance sheets. We heard from Michael Saylor earlier today that he plans to do more. And there was a really interesting survey by Gartner. They surveyed 77 finance executives in February and found that only 5% plan to hold crypto on their books this year at all. And to Joey's point that a 1 to 3% allocation probably looks appropriate, does that 5% figure strike you as a high or low number? And how important is getting Bitcoin on balance sheets to continuing the rally that we've seen over the past year?
Well, for corporate treasurers, it's not important because that was always going to be, I think, a fairly small piece of the pie for now, because the accounting for Bitcoin is asymmetrical. It's not pretty. It's accounted for as an indefinite intangible, same accounting as gold. And what it means in plain English is it's carried on financial statements at the lower of cost or market, unless you happen to be an investment company, which corporates generally are not. And if it's lower of cost or market, you're always marking it down. You're never marking it up until you sell it. So a surprise impairment charge may hit. I have called on accountants to work with FASB to fix this, because one of the strange things is if a corporate buys Bitcoin through a fund or gold through a fund, then they get to mark it up and down. But if they actually buy the underlying Bitcoin or gold, they only get to mark it down until they sell it. That's just that's just the wrong accounting, and FASB needs to fix it, just like we fixed the laws to accommodate Bitcoin in my native state of Wyoming. The accounting rules need to be adopted for the reality of the new world we live in.
So from your point of view, does that kind of increase the urgency for SEC approval of a Bitcoin ETF, for example?
Well, we're starting to see more institutional funds, so I don't think that the two are related, but I do think there are a number of corporations. If we step back and ask about the corporate treasury bid for Bitcoin, what MicroStrategy has done is really not that different than what the big German industrialists did as they started to see the devaluation of the currency ahead of the hyperinflation. I'm not predicting that hyperinflation is going to hit. I'm just saying that there is a historical analogy. And we have a number of tech companies, Square included. Square started with a 2% allocation, now moved it up to a 5% allocation. Obviously, Tesla, Overstock.com was the first to do it back in 2014. So it's a small number of companies, but where I'm going is that especially the tech companies have huge cash piles, and they really do need to start thinking about that cash as an asset that may be burning a hole in their pocket. What is the purchasing power of that cash in this environment? And is there something that they should be doing as fiduciaries for their shareholders to protect the purchasing power of that cash? And I think especially tech companies, it's not a surprise to me that some of the most forward-thinking, innovative companies are the first ones to dip their toes into this water, and in spite of the difficult accounting, are making allocations because they're making a judgment call that it's the right thing for their shareholders in order to maintain the purchasing power of the corporation's assets.
So this brings to mind a kind of philosophical question for me, and I want to swing it to you, Nick. So as we see Wall Street and various companies get more involved with crypto and growing institutional adoption, that's been cited as a big reason behind this bull run that we've seen. But I'm kind of wondering, is that embraced by Wall Street kind of at odds with the original spirit of Bitcoin?
That's a good question. I think a lot of early Bitcoin adopters did expect that Bitcoin one day would become a global storehold of wealth that was material in scale. Certainly Hal Finney did. And I think it would be naive to imagine that growth would not be accompanied by institutionalization. I think the question is really, can Bitcoin, the asset, resist capture from Wall Street or any large asset managers or financial firms? And I think we have strong evidence that the answer is yes. So in 2017, there was effectively an attempt to capture and a sort of change that a lot of Bitcoin corporates were trying to push through to Bitcoin, and that was defeated by the community that wanted to keep it more in line with what they felt were the core values of the project. The other thing that's interesting about Bitcoin is it's relatively frictionless to take final physical delivery of the asset. So even in the presence of intermediation, that's not a deal breaker for Bitcoin in terms of individuals being able to really, take ownership of their keys, because it's easy to exit a custodian or a bank or an intermediary, which means that it's more difficult for the asset to get truly captured and put into some sort of walled garden situation like we see with gold in the LBMA. So the asset itself has these properties which make it sort of uniquely resistant to capture and empower individuals and regular users relative to those third-party intermediaries. So I think that's real cause for optimism.
So we actually have an audience question, which kind of gets at what I was saying about the spirit of Bitcoin. It's if and when it happens, what effect will the advent of central bank digital currencies have on Bitcoin and all other cryptos? So Nick, let's stay with you, but I mean, I'd love to throw that question at both Joey and Caitlin too, if you'd like to share.
Well, I'll start. So I've been following the CBDC debate very closely. I read all of the white papers published by all the various central banks, and the one commonality that sticks out to me in every single one of them is language to the tune of, yes, we need to have embedded KYC and AML. We need to have embedded surveillance capacity. And they sort of beat around the bush at all, but you won't find a central bank out there saying, we are going to provide an instrument which is digital but has the exact same qualities as physical cash, which is true privacy and true transactional autonomy. You will not see a central bank committing to that with their CBDC programs. So if you compare Bitcoin to that, Bitcoin does give you transactional freedom that is by design, and it gives you a measure of privacy. So to me, I see Bitcoin as starkly opposed in the objectives and the things that it permits you to do, starkly differentiated from a CBDC. And so while CBDCs may look cosmetically similar to Bitcoin, it's a completely different product. So I don't really see them competing on the domains where Bitcoin thrives, which is transactional freedom, transactional autonomy, and ability to resist surveillance.
And I would add to that. Oh,
yeah, definitely.
Nick said it very well. Inside the fiat currency systems, of course, is the global agreements that are driven primarily by U.S. foreign policy to require surveillance on banks. Bitcoin itself is not surveilled, but it is important to understand that it is a pseudonymous network, not a anonymous network. And the ability to plug Bitcoin into the banking system is a function in part of the fact that there are surveillance firms, private surveillance firms, that can actually trace transactions. This is in part how law enforcement is done on Bitcoin. It is not an anonymous network, and as a result, there is not as much illicit finance as one might think. And one of the biggest reasons for that is precisely because criminals now know that they can be traced. And you can always trace some crime created with a keyboard back to an IP address.
Mm-hmm. Yeah, and I think, Joey, unless you continue, sorry.
Oh, I was just going to say, I think it's pretty different, like the whole kind of central bank digital currency thing. It reminds me of like when people when the internet first came out, they took photos of newspapers and put them on the internet. That's sort of how like the newspaper business initially migrated to the web. And I think it's just so different. I think, for this stuff to succeed, it really almost has to be kind of a parallel system built from scratch. And then there's going to be bridges and companies that bridge the old system and the new one. But it's not like you're going to be able to just create a central bank digital currency and the average consumer in the US is going to have access to it. And it's amazing. It kind of reminds me of fintech companies. I think most of fintech today outside of the blockchain space is sort of like putting lipstick on a pig. You still have the same broken rails underneath. And so you can't do a whole lot with that, which is why you have apps like Robinhood, which are pretty cool. But, if you look at the GameStop example, these systems still break down because the fundamental stuff at the core is really antiquated in my opinion.
So, Joey, I want to stick with you, and I want to return to a topic we touched a little bit on, but economists up and down Wall Street have been warning that inflation is coming as the economy gets closer to reopening and we potentially have another big fiscal package on the way. But what's interesting to me is that even as bond yields have been backing up and break-even inflation rates have been rising, you haven't seen much action out of Bitcoin. It's been really treading water, it feels like, through much of this action. So I'm curious whether, the activity over the past week or so has put a sort of a dent on that Bitcoin as an inflation hedge thesis.
I don't think so. I mean, I think, Bitcoin went from 20 something thousand last year to now it's in the 50,000s, which is, massive outperformance relative to every other asset class. And it doesn't go straight up. This asset, because it's so volatile, it does often have, 30 to 40% pullbacks, even in the middle of a bull market, which is really wild. In traditional finance, a 30 to 40% pullback would be a massive bear market. In crypto, that's a swing that you see along the way as part of the bull run. And so I think it's still pretty healthy. I think in terms of price action, I think things will be kind of back to normal, by April, if not sooner. I think the market just sometimes takes a little bit of time to let off steam. It's not going to go up in a straight line.
So you wouldn't connect the price action of the past couple of weeks to the inflation debate that's been percolating within more traditional markets?
I think there might be some connection there. There is more traditional finance players taking part in the crypto markets, but still, it's not that huge. You still have a huge amount of traders based in Asia, some in Europe. It really is a global phenomenon. And so I think part of it may be that macro kind of story that you're mentioning. And then part of it's just, it ran up super, super rapidly in Jan and Feb. And the market sometimes just blows off steam. And, the macro stuff is kind of a story that people tell to explain why it kind of came off a bit. But I think you can also explain it just by, technical indicators as well.
So in a panel about the value of Bitcoin, I feel like I have to bring up Tether. So just to recap the news from earlier this week, Bitfinex paid to settle a New York probe into Tether, and New York Attorney General Letitia James said that Tether's claims that its virtual currency was fully backed by US dollars at all times was a lie. So Caitlin, I mean, given that about 55% of all Bitcoin purchases are estimated to be conducted with Tether, what does this mean for Bitcoin going forward?
Well, Bitcoin is connected to the traditional fiat currency systems. There are bridges, to Joey's point, about that enable money to flow in and out, and that is really important to the growth of the network. Had those bridges not been there, we wouldn't be where we are in terms of the network effects. And that is exactly what Avanti is building, a bridge. And we are actually approved to issue, not open yet, but approved to issue something called AVIT, which is actually going to be issued on a Bitcoin layer 2 technology, the Liquid network. And it would be a banknote. It is actually a commercial bank obligation akin to a digital cashier's check, different than a stablecoin in legal and accounting and tax structures. Of course, I can't give advice on any of those three topics, but it's designed to solve some of the institutional challenges with stablecoins, which exist in a gray area on those three topics. And so in the retail market, you're absolutely right. Tether has actually been one of the most important liquidity drivers for crypto assets generally, because it's a US dollar equivalent token. And where I'm going is that it actually turned out to be a very important bridge between the two industries, and the more bridges that we can build, the easier it is for money to flow back and forth between the two. I completely agree that the crypto sector is being built in parallel. It is fundamentally, its architecture system-wise is very different than the architecture of the traditional financial system, which is built on intermediaries, layers of intermediaries, and built on a delayed net settlement basis, whereas the crypto industry is built on a real-time gross settlement basis that enables peer-to-peer. Those are fundamentally different architectures, and it is very difficult to plug in that new architecture into the old traditional financial services companies, which is why the industries are being built in parallel, and bridges like the tethers and stablecoins of the world have turned out to be very important infrastructure to bridge the two.
Well, Caitlin, let's keep in touch on Abbott because that sounds fascinating. But Nick, I want to bring a kind of ethical question to you when it comes to Tether. It's interesting to me that, Letitia James said that this turned out to be a lie, but the community just continued to accept that and keep using Tether. I mean, is there any takeaway there that on an ethical level that, the community was so willing to write that off?
Well, if you listen to what the community has been saying, we've been asking Tether to produce solvency attestations for years now. And for whatever reason, they failed to do so, which is disappointing. But if you look at the settlement, there's an agreement to provide 2 years now of transparency as to the reserves. So that's good news. And I think whether you're a Bitcoin critic or an enthusiast, you should be celebrating that. Tether's lack of transparency was a black cloud hanging over the industry for a long time, but this settlement kind of puts a coda on that. It provides us some assurances, assuming that these reserve attestations do occur, that Tether is backed, which is good news. Historically, as we found out with the settlement, they were unbacked for certain periods. To me, that's indicative of the way that the government and the bank sector engages with the crypto industry, or they've engaged historically, which is to deplatform firms like Bitfinex and Tether. And so a lot of their troubles trace back to the state using the banking sector to deplatform disfavored industries. That seems to have changed a little bit now for the better, and so now crypto firms can obtain banking. But the ultimate responsibility for Tether's struggles lies with these efforts like Choke Point to keep crypto out of banking, and I'm pretty glad that that's not the case anymore.
So we have just over 2 minutes left, and I want to close with a kind of rapid fire round for you guys. I'm curious, what in the crypto sphere in the next 12 months are you most excited about? So Caitlin, kick us off.
I think the Federal Reserve this year is going to have an official pronouncement related to crypto firms getting access to the payment system. There are multiple applications now in front of it, and big policy issues, but big policy opportunities. I completely agree with Nick's prediction that having these instruments inside the banking system, especially US dollar stablecoins, actually is good for the US dollar's position as a reserve currency.
All right, Joey, you're up next. What are you excited about in the year to come?
Yeah, I think I'm probably most excited about the whole decentralized finance sector. People are basically rebuilding finance kind of from the ground up with a clean slate. Everything from lending to new asset issuance to trading to brokers and custody, all in a decentralized manner. And I think that's super exciting. And the only other thing I'm excited about is I'm excited about layer twos, both on Bitcoin and also on Ethereum. I think, I've been in the space a long time, and everything's been 7 to 10 transactions a second for so long. And I think this year that's going to actually change in like a meaningful way where the actual end user gets to see it a lot. And so I'm excited for that.
All right, Nick, bring us home. You have 20 seconds. What are you most excited about in the year to come?
I would say renewed credibility from the intermediaries in the Bitcoin and crypto space. So proof of solvency, proof of reserve attestations. I know there's a lot in the pipeline there, and that will allow them to be seen as just far more credible by the depositors effectively.